Thanks very much. A number of you will know some of the panel members today, and the intention of this session is twofold. One is to explore some of the catalytic roles that the DFIs can play in this particular space. But the second and recently arranged purpose of the panel is to also introduce Noel Adu, who has very kindly agreed at very short notice to sit on the panel to give the audience a little bit of insight into how SNIT is thinking its way through some of these issues as well. I'm going to be gentle with him because he has been persuaded up here at short notice, so please don't throw too many curveballs at him. But I'll start with Yvonne. And for those of you, I'm sure many of you know FMO, but FMO is fairly unique among the European DFIs in its capital structure, the mixture of private ownership and state sponsorship. And I think that blend, in my experience certainly, has made FMO one of the more dynamic and innovative of the DFIs. Hywel, many of you will know, for many years at CDC, ending as the managing director until recently, has a number of roles now, including advising to CDC as well. CDC, for those who don't know, is the oldest DFI, not just the oldest in Europe, but the oldest in the world, set up in 1948, long before even IFC was a little glint in the eye. And so CDC itself has many years of particularly private equity experience, but is going through something of a resurgence at the moment. So I think we're all interested to hear how CDC is approaching this, and more broadly what insights Hywel has from his history. So I think before we get on then to SNIT, I'll just start with Yvonne. Would you like just to talk us through your experience of the pension fund world from the FMO perspective, and particularly some of the new initiatives?
Yeah, thank you very much, Chris. Well, for FMO, catalyzing commercial investors is one of our formal strategic objectives. And it's catalyzing, it's a term that some people don't always naturally understand. I think it's very typical to the development finance community, but it simply means bringing other financiers along. And as a DFI, we had noticed that we were often asked by investors whether they could join us in our deals on a deal-by-deal basis, or following us when we had, for instance, supported private equity funds in their first close, and we saw the commercial investors following in second close, or maybe more realistically in follow-on funds. And we were thinking that there should be a way to institutionalize this catalytic role in a more direct manner, which led us to establish FMO Investment Management, which is a dedicated unit that structures vehicles that allow institutional and other private investors to join FMO in our activities, in our investments, and thereby benefiting from the networks and the experience that we have built over more than 40 years investing in emerging markets. And this is a new business that I'm responsible for and that I'm very proud of, and that I really believe will take FMO to the next level, because, as I remarked earlier today, we're proud to have been pioneers in Africa and in emerging markets in general, but we don't like to remain pioneers forever, and we really like others to join in more massive numbers than we have seen today.
As you crowd in these investors, do you think differently about the different class of investor? So here we are at a pension fund conference, primarily talking about pension funds. Do you have to think differently in how you crowd in pension funds in Africa from other parts of the world, and indeed pension funds as opposed to other forms of investor?
Yeah, there are differences. For us, pension funds and insurance companies, mostly because of their size, are a natural target group, because we need our activities in this field to have a meaningful size also compared to FMO's overall balance sheet, which is 6.5 billion euros. There is a difference in not so much the issues pension funds are dealing with, because I think those are quite universal across the world, but there is a difference in what they consider important. One of the key differences that we've noticed is the importance they attach to environmental and social issues, which in Europe is really a big theme for the pension funds, and which in the US is really something that is hardly ever mentioned or discussed, and sometimes even avoided, because there is this misconception that it would conflict with the fiduciary responsibility of the asset managers. So that's an interesting difference, which doesn't mean we have different propositions. It just means we tell the propositions in a different way.
Hywel, is the role that you see being played by CDC and others similar to FMO? Is there a consistency there? Is it just the private equity space they're looking at? Is it other asset classes?
I think if I can sort of step back, I think we're in a very interesting time in Africa. Most of the time that Yvonne and I have been working in our respective institutions, capital has been coming from outside in, and that's what we've been assuming. And the DFIs have probably been the most sort of regular, supportive, long-term committed capital investors to Africa. And what we're beginning to see now is an emergence of investable long-term capital on the continent, for the continent. And that's a sea change. That's a very big deal. And I suppose it came home to us. You know, there's always been South Africa there with $300 and some billion or whatever. But that's generally been invested domestically. South Africa's never been high on the priority list for the DFI community just because of the nature of the beast. And they stuck a lot of their money offshore as well. But with the Regulation 28, which now allows South African pension funds to have an extra 5% that they can put into the rest of Africa, and 5% of 300 billion is a lot of money. Then you've got what's going on in Nigeria, which we had Sadiq telling us, 25 billion growing at 20% per annum. Already some sort of anxiety about what it's doing to domestic asset prices, the share prices, and a concern that because the regulators don't let them go offshore, how do they place this money in a way that is actually going to help their beneficiaries in the long term? Transformation going on in East Africa, which we heard about, from Provident to pension fund, trebling, quadrupling the amount of capital that has to be invested. So we're going to find, and we are already beginning to find, pension funds wanting and needing to place capital that they didn't have before. And then there's this reliance on the advisory community, essentially Forbes and one or two others. And their mandate is to try and help these guys get a sensible asset allocation, but they're rewarded on they get relatively short-term contracts to do this. They're not rewarded on a long-term basis. They're not invested in the same way that private equity would be. That's not as appropriate they should be. Inevitably gives them a slightly shorter-term time horizon, because a negative performance in 1 year might not mean that their mandate gets renewed the following year. So they don't want to take too many chances either, which leaves the alternative assets in a place where they don't really have any champions. You've got trustees who don't understand them, who are nervous about fees and leakage and so complicated legals. And so you end up in a situation where, whilst there are regulatory challenges now to private equity in Africa, the pension funds are not doing what they could already do. So South Africa could do, 10% private equity? It's probably 2 or 3% at most. Kenya could do 10%. They mainly use that for real estate development, and they're not sort of investing it in private equity. So we see that one of our roles can be to try and help pension funds begin to build private equity portfolios, which give them, if we take the parameters from the rest of the world, 2 or 3% above market returns. Now that's in efficient large capital markets, and we know Africa does not have efficient large capital markets. We have stock markets that are thin, where information is asymmetric, where governance is not necessarily very high. Private equity offers you an opportunity to have a more controlled, better governance, longer term investment, but it comes with the risks of illiquidity and J-curves and things like that.
But where you have information asymmetry, and you're absolutely right in saying that, do you think that a European institution located in London or in The Hague, albeit with satellite offices, is the best guide?
Because we're not in the stock market trying to make bets and trade things. Right? We're taking long-term positions. We're saying, are these managers competent, capable people? Do we trust them? Are they honourable people? Do they know the market, and can they transact? And if we find people like that, we put capital behind them, and we build a cadre of intermediaries who can recycle savings locally. And that's, I think of about half the funds that we have supported over the last decade have been first-time teams. And so we see as part of our mandate to try and establish a body of credible fund managers. At the moment, there aren't enough in Africa. There are too few. And we need to create more, and we need to deepen that market so that there's more opportunity for pension funds to put money away. But there's also an education process. Mm-hmm. The trustees are very nervous about it at the moment.
Well, I mean, they have a heavy responsibility because they bear the
and,
role of a trustee for the pensioners of the future.
And it's reflected in the way Nigeria is doing it, because Nigeria says you can invest in private equity so long as the DFI is doing it as well. So the regulator is sort of saying, well, actually, we're a bit nervous here, and we want to have tangible evidence that this makes sense. So we'd like to work with the pension industry to help them invest in private equity. We don't quite know how we want to do that, but certainly initially, just sharing information, helping them understand the asset class, doing due diligence together, that sort of thing can help them become comfortable.
I'm glad you raised this whole shift, or this whole question of recycling local savings. I mean, I think as well as the obvious statistics that are coming out, which we've heard. I mean, I was in Tanzania last week, and everyone was talking about the mattress account. How much money is stuffed under the mattress, and there's an enormous latent savings in a lot of these countries, which, if everything else fits into place, will come forward. I'd like to turn to Noel, and thank you again for joining us. Noel is the General Manager in the Investment Development Department at SNIT. Now, SNIT is the largest non-bank financial company in Ghana, so that gives you kind of an idea of the relevance of pension savings and other forms of savings. Would you like to tell us a little bit about SNIT and what your priorities are?
Yeah, thank you very much. As you rightly said, SNIT is the largest non-bank financial institution in Ghana. Basically, SNIT is responsible for the pensions payments in the country. It's actually a pension fund company, and has gone through a number of reviews and modifications. The last being 2010, when a new law was passed, to the effect that from the initial contribution of 70.5% to the scheme, a second tier and a third tier subsequently was created, and we had to cede off about 5% of our contributions to finance some of those schemes. This has come with a lot of challenge in terms of being a defined benefit scheme. We still have to pay the same kind of benefits, pensions that is due to people who retire. What this means is that we really have to be a bit more aggressive to look for more better investment opportunities. And as a result of this, in the last, let's say, 4 to 5 years, we've tried to venture into the private equity investment terrain. I think currently we are investing about four private equity firms. I think together with FMO, we are in the Fidelity Fund 2. We're also in the emerging capital market, that's the ECP, and the Canadian, that's the CIFA, as well as the PIDF for South Africa. Unfortunately, our total portfolio in these companies is just about 0.66% of our total portfolio. I mean, that tells you that we're still not out there yet. But I think recent developments in the country, for instance, I've pointed in Ghana, I've pointed in terms of our currency depreciation, I've pointed to the fact that we really need to be a little bit more aggressive to get into the private equity terrain, especially those that are centered outside, because by law, we are traditionally supposed to invest basically just in Ghana. We are not supposed to invest outside directly. We can only invest through the private equity firms. So going forward, what we want to be doing is to step up our game in the private equity firm. I mean, from the 0.66%, I was just talking to my Director General, we really need to go out there a bit more as a kind of a hedge against any such currency depreciations in the near future. So aggressively, I'm happy to hear my colleagues talk about engaging the pension funds a lot more, and we're looking forward to partnering with most of the people here as to whatever investment opportunities there are that they can partner with SNIT for us to undertake, because all our funds are placed inside, so sometimes you have so much money you have to place in certain investments that are not too good, but the opportunities are very few. I mean, our market, the stock market is so small. Currently we just have 37 listed equities, and SNIT, we are investing almost about 25 of them, and we have in excess of about $2 billion on the Ghanaian market. It's choked. There's nowhere else for us to go out. So this forum, I believe, serves as a very good opportunity for us to look at other ways of investing our funds. Yeah. Okay.
So I think you mentioned that you're already looking at some of the funds that you've invested in together with FMO.
Yeah.
That is a trend that will continue, that you will look to the DFIs maybe to partner with you?
Yeah, that's what we're actually looking forward to. As we speak now, I think just before we came in last week, we had a deal with KFW. I think that's the German wing of the development, and we're doing something together. I mean, we had a very good meeting, and then that's the way we want to go, to deal more with the DFIs. Some of them know our terrain even much better than we do in Ghana, and we think that there are several prospects that if SNIT, together with any of these DFIs, come into, we can add so much value to some of the investments that we have in Ghana. Traditionally, I must say that, SNIT has revolved from the perceived government, run pension scheme and stuff like that. So our investments were initially being controlled to some extent as to economically targeted investments where you have to direct funds to and stuff like that. But as I speak now, that is doing those, to a very large extent. We decide where we want to invest for the best returns, but we're still reeling from the effects of bad investments that we've done in the past. I'm sure you're all aware of a recent bank, that's Merchant Bank, that had to be, gotten rid of as part of the SNIT investment. It's an unlisted bank, and which was not doing well. But each and every year, we had to pump in so much money in terms of equity. We never got anything out of it in terms of dividends. But because it was SNIT, the management always thought, oh, come on, the pension fund will still bring money all the time. But we got a local private equity firm in Ghana. That's the first of its sort, locally, made, shall I say, private equity firm, which actually invested into the bank. And in the last 6 months or so, it's turned out to be doing a bit better. But when it was SNIT, nobody really cared, because the perception is that it's all of us are money. So why who cares? When it goes down, they'll still put in more money. So I think the perception is changing.
I'd like to ask that point about the economically directed investment perhaps to Yvonne and Hywel. Please come in if you have any views on this. As one of the roles of the development finance institutions is to help grow the economies with the aim of reducing poverty and so on. Do you see synergy, or do you see conflict in how pension fund money is potentially invested, because on the one hand you want to see the big projects in the country come up, but again those may not be the ones with the highest return for the pensioners. Is that something which gets debated within FMO, for example?
Well, there is a perception, not within FMO, but outside of FMO, that a positive development impact would conflict with a good return, which is not true, or which does not need to be true if you select your projects well. So I don't think there is a huge tension. Of course, some projects are difficult to finance on a purely commercial basis, but those are typically not the private sector projects that we pursue. So in that sense, I also think the pension funds should not, and that's a debate even in the Netherlands, where the government is trying to push the pension funds to invest in renewable energy or all sorts of, let's say, policy-driven initiatives. And there you see the pension funds strongly resisting against this pressure, because what they are concerned about is that they should only invest in viable projects.
I mean, at a very sort of high level, I remember 3 years ago, this conference, the first one, there was a lady, I think, from South Africa who justified an element of directing investments into the infrastructure and into productive uses on the basis that it's very logical that you may have a pension when you retire, but if the country you live in hasn't been developed and the roads aren't there and all the other services aren't there, the quality of life is not going to be so good. You may have your pension, but you can't spend it on anything. How?
Yeah, I mean, I think we're natural bedfellows in many ways. We're long-term investors, so we're not in and out. We're looking at sort of 6-10 year type returns, and we're looking to have a balanced portfolio on that basis. You don't want to have all your eggs in one basket in any particular economy. That puts you in a very similar place to the pension funds. They can afford to take a longer-term view. We come with fairly robust and well-developed systems for making sure that the environmental, social and governance aspects of a business are taken care of. That's something I think pension funds would appreciate and would help reduce their anxieties and risks. And I think, as Yvonne was saying, it's a false dichotomy, this idea that you make money at the expense of development, as if in some way it's an inverse relationship. It's not. It's that they're closely correlated. We would look through a series of filters to decide what to look at, but once we're through those filters, we want to make the best return we can, and that's the efficient use of capital within the economy, and that's the best way to grow the economy. And I think the IFC did some work, did they not, that demonstrated that the best development impact was associated with solid returns as well. So I don't think that's a thing to be concerned about.
And we talked about a few countries. In terms of if you were to single out the countries where the process is working best, where we can learn lessons from how it's being conducted, where are the most fertile places to invest now, and where do you think that technology can be transferred to, and what preconditions need to happen before these other markets open up? Because it's not a level playing field at all.
You mean for pension funds
yeah.
to invest? Yeah, I would really like to ask Noel's opinion, because we've seen SNIT as our co-investor in some very early private equity investments, which makes them a great example to the African pension fund community. And I would be interested to know what's working so well within SNIT and also the governance structure, that apparently your trustees have been comfortable with this product and have not need a lot of, well, maybe they have had a lot of education, but I'm not aware of it. So in other countries, trustees seem to be the main hurdle. How did that work for you?
Yeah, like I said, we've had some pension reform quite recently, since 2010. And there's a lot of responsibility on the trustees. I mean, as I said earlier, now because of the new scheme of things, there isn't much government control on the trustees. I mean, the ultimate is for them to add value to the extent that will be in a position to be able to pay pensions and other benefits as and when they fall due. So the focus is a business-minded sense. I mean, it's like, well, it's a safe investment. It will bring us so much return for us to be able to sustain our scheme. I think those are the very underlying factors that are looked at. The trustees currently don't really look at so much of government or economically targeted investments. If it adds value to our total portfolio to the extent that we'll be able to pay our benefits as and when they fall due, that's it. And I just want to add one other problem that we face is within SNCs. It's a capacity. I mean, shall I say, especially in dealing with the DFIs and the other financial institutions. I think I should say that, fortunately, I've been in investment banking for 15 years or so before I joined the scheme. And I look around, they are very good, very trainable people, young men and guys. And I believe that when they are given the exposure in terms of capacity building, I mean, maybe getting some opportunities to be with some of the DFIs and some of the other partners in the investment arena, they will be in a better position to be able to add much more value to the scheme. I mean, because of where we've come from and where we are. If I may confide in you, we've been a bit limited in dealing with most of the DFIs because we have not been able to appreciate the way they do their things in a much more critical manner. And I think I'll use this platform possibly to make an appeal. I mean, we'll be ready to maybe, together with my Director General's consent, to send a few young men on attachment with some of these organizations to teach them how some of these things are done. And then when they come back, we'll be in a better position to partner you guys on the way forward.
Well, it is very early days. We talked about how the volume of money is beginning to grow, the regulatory environment's not clear. I mean, we've co-invested in funds with about 15 local pension funds in Africa, but that's been very much a Southern Africa and a bit of Nigeria. Not much else happening. And if you look at South Africa even, where you've got a lot of money, there are a handful of pension funds that have any investment staff of their own. So that we've got a long way to go in building capacity. And I think that's the focus for the time being, is let's get funds capable of making these investments and let's start to build it.
Okay, I think at this moment I'd like to throw it open to the audience. Anyone who has a question for any of the panelists, I think we've got about 5 minutes left, including anyone who would like to take a secondment from SNIT, from Noel's team. Speak up. Do we have any questions from the audience? This gentleman here.
It's a question for if each member of the panel could give their perspective. But with the DFI sort of leading the investment in Africa, specifically outside of your usual sort of resources sectors and infrastructure, how do you see the sort of private sector investment coming in and where that fits in the timeline between domestic pension funds investing and your, I don't know how to put it, your more sort of aggressive, just general investors who are looking to participate in the growth in Africa?
I mean, you don't get aggressive, well, do you? It's not, aggressive investment in private equity don't sit easily, I don't think. If you're looking at a closed-end fund with a 10-year life, you have to be patient. There's no way around it.
I mean aggressive from a risk perspective.
Okay. Yeah, I mean, if I think about the funds in Africa that we've backed, there are some funds which have had a relatively high proportion of private capital. I'm thinking some of the infrastructure type funds have done that. But At the other end of the spectrum, there are funds which are pretty much wholly reliant on DFIs that are prepared to take more risk than the private sector, and that's part of their job, is to push that risk frontier out.
Yeah, that we also see, so especially in some of the smaller funds that we support with dedicated money from the Dutch government for higher risk, high developmental funds, we see family offices. And some of them are quite advanced in their risk appetite.
And you have structures where you might have first loss and mixing the risk within its individual funds, or is that not normal?
We haven't applied that structure in private equity. I have discussed it with several pension funds, and I noticed that the concept of first loss was not really appealing because it made them conscious or afraid of the idea that they could lose principal. So I think we need to look at structures of return enhancement rather than first loss, which I haven't been able to figure out how this would work, return enhancement, but that's something I believe in more than first loss. First loss is more for debt, I think.
I mean, from my perspective, and I don't want to steal the thunder from the next panel because I have a couple of colleagues who will be sitting on that, but from GuarantCo's perspective, we really deal just in debt, not in equity or private equity. So the process that we see in crowding in additional players into the market it follows a slightly different route. But in those situations, we are prepared, and others like us are prepared to lead the way by taking a first loss position in order to catalyze more investment, with the hope that within a short space of time, the market will catch up and no longer require that particular form of assistance, and we'll be out of the job. But I don't know, Noel, if you had any comments on that particular question.
No.
Do we have any other? Sorry, do we have to finish now? Okay, all right. Well, I'd just like to thank the panel very much, to Yvonne Bakkum, to Hywel Rees-Jones, and to Noel Adu. And please give them your appreciation.
Thank you.
Thank you. Thanks a lot.